Hello and welcome back to the Geordie Pig Investor channel, where we dive deep into the world of dividend investing to help you build a portfolio that pays you. Whether you're just starting out looking to maximize your passive income, this channel is your go-to resource for strategies, insights and the tools you need to grow your wealth steadily over time. Hit that subscribe button and join me as we explore how to make your money work for you one dividend at a time. In today's video, I'll be breaking down my InvestEngine portfolio performance for the past month, what went up, what went down, any changes I've made and my thoughts going forward. Whether you're a long-term investor or just getting started with InvestEngine, this should give you some insight into how a diversified portfolio behaves over time. I created this portfolio to show you all that you don't need to have millions to start investing, and by putting away some amount each month will be very beneficial over the long term. As you can see, my portfolio is split between my general investing account and my individual savings account. The reason it is split is because before last year you could only hold one ISA account, which was over on my main portfolio in Trading 212, but since then they have now allowed you to open as many ISA accounts as you want, with the only caveat being you can't exceed that £20,000 yearly limit between all of your accounts. So since this came into play in April 2024, I have been investing £100 every single month, and I'll be adding that £100 with you today. Eventually, I will move the money across from my general investing account into my individual saving account, but I'm in no rush to do so. My portfolio is quite unique as every single ETF is classified as a factor ETF. A factor ETF is a type of exchange-traded fund that targets specific characteristics or factors that have been linked to better investment returns or lower risk over time. Some common factors include value, so this would be stocks that are cheap relative to their earnings or assets; growth, which is companies growing faster than the average; momentum, these are stocks that have performed really well recently; and quality, which is companies with strong balance sheets and profitability. So instead of tracking a broad market index, a factor ETF aims to give you exposure to certain strategies or styles of investing that suit you best. I feel in the portfolio that I am showing you today, I have a good blend of different factor ETFs I personally want to be exposed to. Anyways, let's see how these ETFs actually performed over the last month. So this was one of my best ever months, being up 5.1% in the last month, and if we compare this to the last couple of months prior, we were taking a bit of a beating, so it's nice to actually see some green for once. If I do compare my own portfolio against the S&P 500, we can see right now that they actually had a monthly return of 6.16% in May, whereas my portfolio wasn't quite up that same amount, so we were slightly behind the S&P 500, but not by very much. In particular, my best performer this month was my biggest holding in the portfolio, which is the UBS Factor ETF, stock ticker UC99. This is an exchange-traded fund designed to provide investors with exposure to US companies that exhibit high-quality characteristics and adhere to environmental, social, and governance criteria. The fund aims to replicate the performance of the MSCI USA Quality ESG Low Carbon Select Index, which focuses on US companies demonstrating strong quality traits and robust ESG practices. If we go down a little bit further, we can see the top three holdings within this one are all in the tech industry, with Microsoft being the biggest at 8.4%. We then have Apple at 8.3% and Nvidia atop the top three off at 8.1%. This ETF is actually heavily weighted towards industrial, with it being the biggest portion of the ETF at 40.1%. The next biggest sector being tech at 26.1%, and then you have financial rounding off the top three at 8.2%. I have this as my biggest allocation due to its very strong performance since inception. The fund has achieved an average annual return of 18.09%, including dividends, which means it's actually outperformed the S&P 500 since the inception date. The next best performer in the month of May was none other than the X-Trackers World Momentum ETF, stock ticker XDEM. This is an exchange-traded fund designed to replicate the performance of the MSCI World Momentum Index. This index focuses on global large and mid-cap companies exhibiting strong momentum characteristics. You can see that this ETF is up close to 7% over the last month. It has Meta as its top holding, sitting at 5.1%, followed by Apple at 4.4%, and then Nvidia at 4.3%. And if we have a look at the sector breakdown, we can see that the top one in this one is also industrial, but a lot lower than the last ETF at only 23.4%. You then have technology just behind at 23.3%, and financials at 21.3%. I like having this ETF as a 15% allocation in my overall portfolio. If you're interested in XDEM, then you should consider its focus on momentum investing, which targets stocks with strong recent performance trends. But as with any investment, it's essential to assess how this ETF aligns with individual investment objectives and risk tolerance. The next ETF in the green for the month of May was none other than my iShares S&P Small Cap 600, stock ticker ISP6. This ETF is an exchange-traded fund that aims to replicate the performance of the S&P Small Cap 600 index. This index comprises 600 small-cap US companies, providing investors with exposure to this segment of the US equity market. Even though it's in a green month this month, it has been my worst performance since starting this portfolio. It is still down just over 8% overall. Having said this though, I still really like this holding in my portfolio as it gives me exposure to stocks I wouldn't otherwise have. The top three holdings within this one are BlackRock Liquidity at 1.4%. You then have Mr. Cooper Group at 0.6% and Quavo at 0.6% as well. And if we have a look at the sector breakdown, it's quite different on this one, with industrial being the top one at 29.5%. You then have financials at 12.4% and property actually comes into it at 7.6%. If you're interested in this particular ETF, just be aware of the inherent volatility and liquidity characteristics of small cap stocks, as they can be more unpredictable and less liquid than larger company shares. As with any investment, like I just said before, you've got to assess if this ETF aligns with your own individual investment objectives and risk tolerance. Again, this one is a 15% allocation in my portfolio, and even though it's overall still in the red for me, I really don't mind this, because when my ETFs are in the red, it means when I add my £100 for that month, it means I'll be buying in at a cheaper price and bringing my dollar cost average down. The next stock in my portfolio is the Xtrackers MSCI World Quality ETF, stock ticker XDEQ. This is an exchange traded fund designed to replicate the performance of the MSCI World Sector Neutral Quality Index. This index focuses on large and mid-cap companies from developed markets worldwide that exhibit high quality characteristics such as high returns on equity, stable year-over-year earnings growth, and low financial leverage. We can see that it was close to up to 5% for the month of May, and the top three holdings include Microsoft at 5.4%, you have Apple then at 4.8%, and Nvidia at 4.7%. These holdings are the same top three as my main ETF from the portfolio, the UC99 ETF, but this ETF has smaller allocations and does hold very different stocks throughout the ETF, with the sector breakdown looking different too. The top three holdings are actually industrial, which covers 21.2%, you then have technology at 20.3%, and financial in third at 19%. I will also add that I don't mind stocks overlapping in my ETFs, as I know it's stocks I'm very happy that have an overlap, as they are high quality. If you're interested in XDEQ, you should consider its focus on high quality companies across developed markets, its sector and geographical diversification, and its accumulating dividend policy. And finally, we have the Wisdom Tree Global Developed Quality Dividend ETF, stock ticker GGRG. This one is actually a 25% allocation in the portfolio and saw just short of a 4% gain in May. This index focuses on dividend-paying companies in developed markets that exhibit strong growth characteristics and high-quality fundamentals. The top three holdings within this one are Microsoft at 5.5%, you then have Apple at 3.5%, and actually AbbVie that rounds out the top three at 2.6%. The fund offers different exposure across the world, with North America only being 58% of the entire fund, and then it has Europe excluding UK at 22.4% and Japan in third at 5.7%. I do really like this one because the ETF gives me more global exposure. We can then see that it's industrial in the top spot for this ETF at 23.1%, technology in second at 19.4%, and financials is the third biggest sector at 11.7%. If you like the combination of income and growth potential through exposure to financially sound, dividend-growing companies across developed markets, then you may find GGRG to be a compelling addition to your portfolio. Overall, I am really happy with the different holdings in this portfolio and will continue to add to them with the allocations I have them assigned to. So without further ado, let's invest the £100 for the month today. It's as simple as clicking it on there, adding it to the screen, press the review order. It'll tell you what the different funds will change to once I add this money in. And then once you've pressed confirm, that order will go through at 2:30 on the next working day. So that will be Monday when we get into June. So that is £100 closer to my future and paying myself first. I love this series that shows by being consistent and adding £100 every month, you can really start to build up a pot, and it's a great way to build up a healthy habit of investing. So remember, by simply investing any amount you possibly can each month, it is seriously a big deal and will contribute to building your long-term wealth. Investing is not about timing the market, but time in the market. Patience turns small seeds into lasting wealth. That wraps up this month's InvestEngine Portfolio Update. If you found this video helpful, don't forget to give it a thumbs up and subscribe for more monthly updates, dividend news and investing tips. Got any questions or want to share how your portfolio is doing? Drop a comment below. I love reading and try to reply to every single one. Thanks for watching, and as always, stay consistent, stay patient, and let your money work for you. Until next time, this is the Geordie Pig Investor, over and out.